For 18 years, he didn't sell a single share. Not during the 2008 financial crisis, not during the COVID crash, not during any of the market chaos that destroyed other banks. For 18 consecutive years, Jamie Dimon, the most powerful banker in America, the CEO of JPMorgan Chase, the man who runs the largest bank on the planet, held onto every single share of stock he owned. He didn't just hold, he bought more, year after year, adding to his position while other executives cashed out. Wall Street noticed. They said Dimon was a true believer, a man with conviction. If Jamie Dimon is buying, the smart money said, we should be buying too. Then something changed. After 18 years of accumulating, after building one of the largest executive stock positions in American history, Jamie Dimon announced he was selling. Not a little, a lot. 1 million shares, hundreds of millions of dollars worth. The most powerful banker in America, the man who knows more about the financial system than almost anyone alive, suddenly decided it was time to get out. And almost nobody asked the obvious question. Why? Why now? What does Jamie Dimon see that we don't? Because here's what most people don't understand. Jamie Dimon doesn't make impulsive decisions. Every move he makes is calculated. Every statement is deliberate. When the CEO of the largest bank in America suddenly reverses 18 years of behavior, it means something. And when you dig into what he's been saying publicly, when you analyze JPMorgan's own internal positioning, when you look at where the bank is moving its money, a disturbing pattern emerges. A $67 billion pattern that suggests Dimon isn't just protecting his personal wealth. He's preparing for something he believes is coming. By the end of this video, you'll understand exactly what triggered Dimon's decision, what JPMorgan is quietly doing that contradicts their public optimism, the historical pattern of insider selling before major market events, and what this means for your money, your investments, and your financial future. Because when the captain starts loading the lifeboats, passengers should pay attention. Welcome to the silent economy. Let's decode what Jamie Dimon knows. Retention goal. Establish credibility, build stakes, explain why this person's actions matter. Before I show you what Dimon is doing, you need to understand why his actions matter more than almost any other executive in America. Jamie Dimon isn't just another CEO. He's been called the most important banker in the world. Fortune magazine has called him one of the greatest business leaders of his generation. When presidents need advice on financial crises, they call Jamie Dimon. When other CEOs want to understand the economy, they listen to Jamie Dimon. Let me give you some context. JPMorgan Chase is the largest bank in the United States. Over $3.7 trillion in assets. That's trillion with a T. They're larger than the entire GDP of the United Kingdom. They have over 300,000 employees, offices in over 100 countries. Their trading operations move markets. When JPMorgan makes a decision, ripple effects travel through the entire global financial system. And Jamie Dimon has run this institution for nearly 2 decades. During that time, he's navigated every crisis imaginable. The 2008 financial collapse, the European debt crisis, COVID-19, regional bank failures, inflation spikes, rate shocks. Every single crisis, Dimon not only survived, but thrived. JPMorgan emerged stronger while competitors crumbled. Bear Stearns collapsed. Dimon bought them at a discount. Washington Mutual failed. Dimon acquired their assets. Silicon Valley Bank imploded. Dimon absorbed First Republic. While other banks were dying, Dimon was buying. This track record is why Dimon's opinion carries weight that other executives can only dream of. When he speaks, professional investors listen. When he acts, sophisticated money pays attention. And here's why his selling is so significant. For his entire tenure as CEO, Jamie Dimon accumulated JPMorgan stock. He didn't just receive stock as compensation and hold it. He actively bought more with his own money. He increased his position year after year, demonstrating conviction that JPMorgan and the financial system would prosper. His total position grew to over $1 billion in value. $1 billion in JPMorgan stock, the ultimate vote of confidence. Then, after 18 years of this behavior, he announced a major sale. This isn't a normal executive stock sale. This is a dramatic behavioral reversal from someone who has never, in 2 decades, shown any inclination to reduce his position. When someone who has been right about markets for 20 years suddenly changes their behavior, you don't dismiss it. You ask, what changed? So let me show you what insider selling has historically signaled. Retention goal, pattern recognition, build credibility through examples, create framework for current situation. Insider selling by itself means nothing. Executives sell stock for many reasons. Diversification, tax planning, buying a house, funding a foundation. But there's a specific type of insider selling that has historically preceded major market events, a pattern that, once you see it, you can't unsee. Let me show you 4 examples. Example 1. Enron, 2001. In the year before Enron collapsed, something unusual happened. Executives started selling stock at a dramatically accelerated pace. Kenneth Lay, the CEO, sold over $70 million in shares, while publicly encouraging employees to buy more. Jeffrey Skilling, the president, sold $66 million before resigning unexpectedly. The sales weren't evenly distributed. They accelerated as the company approached collapse. The executives knew. They acted on what they knew. Employees who trusted the public statements lost their retirement savings. The pattern: accelerated selling by those with the most information, while public communications remained positive. Example 2, the 2007-2008 financial crisis. In the years leading up to the financial crisis, insider selling across the financial sector reached unusual levels. Angelo Mazzillo, CEO of Countrywide Financial, sold over $400 million in stock between 2004 and 2007, while his company was originating the toxic mortgages that would later implode. Goldman Sachs executives reduced their holdings significantly in 2006 and 2007. While publicly touting mortgage-backed securities, they were privately positioning for catastrophe. The pattern repeated. Those with the best information reduced exposure, while the public narrative remained optimistic. Example 3. Tech executives before 2022. In late 2021, before the tech crash of 2022, insider selling in the technology sector reached historic levels. Elon Musk sold over $16 billion in Tesla stock between late 2021 and 2022. Jeff Bezos sold billions in Amazon shares. Mark Zuckerberg reduced his Facebook holdings significantly. Collectively, tech insiders sold more stock in 2021 than any previous year. Then 2022 arrived, and technology stocks crashed 30%, 40%, 50%, or more. Did they know exactly what was coming? Probably not. But they understood valuations were stretched. They understood risk was elevated. They acted while the public was still euphoric. Example 4. Regional bank executives, 2023. Before Silicon Valley Bank collapsed, executives had been selling shares in the months prior. The CEO sold stock in the weeks before the bank run. Before First Republic failed, executives reduced positions. This wasn't clairvoyance. It was executives with inside knowledge of their bank's vulnerabilities taking action while they still could. Now, here's the framework for understanding insider selling signals. Not all insider selling is meaningful. Routine, scheduled sales for diversification are normal. Executives have bills to pay. But certain characteristics distinguish significant insider selling from routine transactions. Characteristic 1, behavioral reversal. When someone who has consistently bought suddenly starts selling, pay attention. The reversal is the signal. Characteristic 2, scale and timing. Large sales concentrated in a short period, especially after years of accumulation, carry more significance than small, regular sales. Characteristic 3, cluster selling. When multiple executives at the same company or across an industry start selling simultaneously, the signal strengthens. Characteristic 4, contradiction. When public statements remain bullish while private actions turn bearish, the disconnect reveals truth. Now let me show you how Jamie Dimon's actions fit this framework. Jamie Dimon's stock sale checks every box of the significant insider selling framework. Behavioral reversal. 18 years of consistent accumulation followed by the first major sale in his career. This is the definition of behavioral reversal. When Dimon announced the sale, he cited diversification and estate planning. These are legitimate reasons, but he could have diversified at any point in the previous 18 years. He chose now. The timing is the message. Scale and timing? The announced sale was for approximately 1 million shares. At the time of announcement, that represented roughly $150 million in value. This wasn't trimming the edges. This was a significant reduction in his exposure. Contradiction between words and actions? This is where it gets interesting. Publicly, JPMorgan has maintained a relatively optimistic outlook. They report record profits. They tout their strength. They express confidence in the economic outlook. But their actions tell a different story. JPMorgan has been building their cash reserves significantly. Their provision for credit losses has increased. They've been preparing for loan defaults at elevated levels. And here's where the $67 billion comes in. According to their own financial reports, JPMorgan has been positioning their balance sheet defensively. Their allowance for credit losses, essentially money set aside for loans they expect to go bad, has grown substantially. They're preparing for significant economic stress. Additionally, JPMorgan's trading operations have taken positions that suggest concern about market stability, their interest rate exposure, their credit default swap positions, the derivatives book, all suggest preparation for volatility, not smooth sailing. When you add up the defensive positioning, the reserve building, and the institutional preparations, JPMorgan has effectively moved tens of billions of dollars into defensive postures. The public message, everything is fine. The internal positioning, prepare for impact. And Jamie Dimon personally is reducing his exposure at the same time. What has Dimon actually said? This is important because Dimon's public statements, while carefully worded, have been more cautious than most realize. He has repeatedly warned about risks that others dismiss: government deficits, geopolitical tensions, inflation persistence, commercial real estate concerns, the potential for economic turbulence. He's compared current conditions to some of the most challenging periods in recent history. He's used language like cautious and vigilant more frequently than optimistic. The message, if you're listening closely, is not everything is fine. The message is significant risks exist and prudent people should prepare. And then he personally started selling stock for the first time in 18 years. Actions and words aligned. Just not in the direction most people want to believe. Jamie Dimon isn't the only one. When you zoom out and look at insider behavior across the financial sector and corporate America broadly, a pattern emerges. Insider selling across multiple sectors has been elevated. Corporate executives with access to forward-looking information about their businesses have been reducing exposure. This doesn't mean they know a crash is coming tomorrow. Insiders are frequently wrong about timing. But it does suggest that those with the best information about economic conditions don't share the public optimism about smooth sailing ahead. Here's what we know with certainty. Interest rates have risen dramatically after 40 years of decline. The adjustment to this new reality is still unfolding. Government debt levels across major economies are at historic highs. The long-term implications are uncertain but concerning. Geopolitical tensions are elevated across multiple regions. Any escalation could create economic shocks. Commercial real estate faces structural challenges from changing work patterns. Bank exposure to this sector is significant. Consumer debt levels have risen substantially. Credit card balances are at record highs. Auto loan delinquencies are increasing. These are facts, not predictions. And they're the same facts that Jamie Dimon references when explaining his cautious outlook. The most informed person in American banking is telling you, through his words and his actions, that significant risks exist. He's backing up that message by reducing his personal financial exposure for the first time in 2 decades. You can dismiss this as routine estate planning, or you can consider that perhaps the captain of the largest ship knows something about the waters ahead. Retention goal, actionable takeaways, personal application, practical steps. So what do you actually do with this information? Let me give you a framework for thinking about insider signals. First, don't panic, but don't dismiss. Insider selling doesn't mean a crash is imminent. Markets are unpredictable. Insiders are frequently early or wrong. But ignoring meaningful signals from those with superior information isn't wisdom. It's willful blindness. Second, assess your own exposure. Jamie Dimon is diversifying his wealth after years of concentration. Consider whether your own portfolio is appropriately diversified. Are you concentrated in a single stock, a single sector, a single asset class? If the most sophisticated investor in American banking is reducing concentration, perhaps concentration risk deserves your attention too. Third, examine your banking relationships. This isn't about panic moving money. It's about understanding that banks have different strength profiles. Consider whether your deposits are within FDIC insurance limits. Consider whether spreading deposits across multiple institutions makes sense for your situation. Fourth, build financial resilience. Whatever comes, whether it's smooth sailing or rough waters, financial resilience helps. Emergency savings, reduced unnecessary debt, income diversification. These preparations serve you regardless of market direction. Fifth, watch behavior, not just words. Every executive will tell you their company is great, their stock is undervalued, the future is bright, but their actions reveal their true beliefs. Track insider selling data at your own brokerage or financial websites. Watch for the behavioral reversals and clustered selling that precede significant events. Sixth, maintain perspective. Jamie Dimon isn't selling everything. He's reducing concentration after an unusually long period of accumulation. JPMorgan isn't predicting collapse. They're preparing prudently for various scenarios. The message isn't panic. The message is prepare. This is the silent economy. Let me leave you with a thought. Jamie Dimon has been right about financial markets for 20 years. He navigated 2008 while others collapsed. He managed COVID while others struggled. He absorbed failing banks while competitors failed. This track record doesn't guarantee he's right about current risks. Nobody can predict the future perfectly. But when someone with his knowledge, experience, and track record suddenly changes behavior they've maintained for 18 years, dismissing it as meaningless seems unwise. He's not telling you the sky is falling. He's showing you through his actions that the sky deserves watching. The sale wasn't panicked. It was measured, methodical. Exactly what you'd expect from someone who sees elevated risk on the horizon and is positioning accordingly. You have the same information now. What you do with it is your decision. If this analysis was valuable, if it showed you something you hadn't considered, subscribe and hit the notification bell. Next week, I'm breaking down exactly which sectors show the most concerning insider selling patterns, and which ones are showing unusual buying, signals that suggest opportunity rather than risk. Drop a comment below. Tell me what you think about diamond selling. Routine diversification or meaningful signal? What are you doing to prepare? I read every single comment. The smart money moves quietly. The headlines come later. The opportunity is in seeing the movement before the headlines arrive. That's the edge. Thanks for watching. This is The Silent Economy, and we'll see you in the next one.